Welcome to Global Insights with me, Punita Kumar Sinha. In today's episode, we're going to discuss the global economy with none other than Dr. Martin Feldstein, who's visiting India from Boston. Dr. Feldstein, thank you very much for joining us today.
Good to be with you.
I really wanted to talk to you about the global economy, particularly the US. You've been a proponent of higher interest rates in the US for a long time. It's finally we've got 25 basis points. And I know you feel that interest rates should rise further. So can you tell us how much interest rate increases are necessary and required according to you?
Well, first let me just say that I think the US economy is in very good shape now. We essentially have full employment. The unemployment rate is 5%. That's half where it was at the peak. For college graduates, the unemployment rate is 2.5%. So it's quite a tight labor market. And if you look at the consumer price index, if you exclude oil, which distorts everything because it has fallen so much in the last year, the consumer price index inflation, other than oil, is up now 2% relative to a year ago. So we basically are at full employment with the kind of inflation rate that the Fed had been looking for. I think the case for raising interest rates, and this is why I've been a proponent of it for a while, is that these extremely low interest rates that we've had at every maturity has driven excessive risk-taking. Risk-taking by investors, risk-taking by lenders. We see it in overpriced assets and in lower quality loans being put on the books. So I think the Fed is right in its projections that it will take the federal funds rate from essentially 0 to about 2 percentage points. But I think they're going to move, at least their expectation, their intention is to move too slowly. And so I think they should be moving faster.
So, you mentioned that inflation, excluding oil, is actually 2%. And that brings me to my question. If you look at the data and you compare it to the previous rate hikes, other than full employment, inflation looks much lower than it has been in previous rate hike cycles. GDP growth is also weaker today than it has been in the previous rate hikes. So why do you feel that the economy is actually doing quite well and as well as it's done in the past cycles?
Well, in the past, the Fed waited too long. So it waited until the economy was not just doing well, but was already seeing rising inflation that had to be stopped and turned around. And that we don't want to happen, because when the Fed has to tighten in order to reverse inflation, that has often been the reason for the economy to turn down. So the idea is to move now before that happens, to prevent the further increases in inflation, and in my judgment, to deal with this excessive risk-taking.
So you're not concerned, as some people are arguing, that there could be a global recession in the future and maybe these rate hikes should be much slower than what you are saying?
Yes, I'm not concerned with that. And I think in terms of a, quote, global recession, you look around the world and each economy is doing something different. Even within Europe, you have some strong and some weak. In Latin America, you have some disastrous situations and some quite positive situations. Commodity prices are driving demand in some countries, but that's not something that interest rates are going to change.
And you don't think that interest rate hikes are going to cause a deflation down the road in the US?
No, I think they're going to prevent higher inflation. I mean, with the unemployment rate essentially at full employment, the expectation of the Fed is that, remember, they're going to still have, by their policy plan, they're still going to have very easy, very accommodative monetary conditions. Real interest rates negative for the next almost 2 full years. So under those conditions, we can see the unemployment rate falling. We can see further upward pressure on inflation. So I think it would be appropriate to dampen that.
Mm-hmm. Now, you talk about the fact that the US economy is doing actually quite well, but when you look at corporate activity and you look at corporate earnings, they've already begun to slow. And so how do you say that the economy is doing well when corporate earnings are already slowing?
Some are not. It depends on the sector. Heavy industry, manufacturing industry, is doing less well. Anything related to the energy sector is doing less well. So it's not just drilling, but the people who make the pipes, the people who make the trucks that are used to bring things to and from energy sites. So it's got a widespread effect. And of course, the price of energy keeps coming down. It's now in the mid-30s per barrel. I think the expectation is it'll plateau out at about this point. Even if it doesn't rise, that means that headline inflation will be going back up because it'll no longer be depressed by falling energy prices.
Staying on the topic of the US right now, what are the risks you see in the US economy? What worries you right now?
Well, I think there are two kinds of risks. I think the short run, just talking about economic risk, the short run economic risk is that these extremely low interest rates, which have, as I said, led to substantial risk taking by investors and by lenders, could create a serious problem. We don't really know. What we know is that the stock market today, relative to the past, in terms of the price-earnings ratio, is 40% higher than the past. If you adjust, as some economists suggest, for inflation and for cyclical conditions, the price-earnings ratio is about 60% higher than it has been in the past. You could say, well, that's okay as long as interest rates are zero. But interest rates aren't going to stay at zero. And if the short rate moves to 2%, the 10-year rate will probably move to 4%. And at that point, clearly those equity prices are not justifiable. We're already seeing problems in the bond market. It started with some of the high-risk bonds, particularly the ones related to the oil sector. There was a run to dump some of those. But now also high-quality bonds, as investors have awakened to the fact that interest rates are going to rise and rise more than 25 basis points. If they're going back to 4% for the 10-year bond, then you don't want to be buying bonds at today's prices. And the market doesn't have the capacity to offset a significant dumping of bonds because of the Dodd-Frank rules that limit what the banks can do. So there's the risk that all of this could create systemic problems. But I put it in terms of risk rather than a forecast because we don't know how much leverage there is out there. We don't know exactly who's taking these risks. And of course, the risks are more complicated in a world where there are derivatives and other ways of putting risk on the books. So I worry that that could come home to roost in the coming year, especially if interest rates are rising more rapidly than people expect.
And what's your second risk?
The second risk is the more long-term risk, and that is our fiscal situation. So right now, the debt to GDP ratio in the US is twice what it was before the economic downturn. We went from the high 30s for a debt to GDP ratio to about 75%. It'll stay at about that for another 2 or 3 years, but then all of the forecasts are it will start to rise significantly. And as it starts to rise, as it heads towards 100%, I'm afraid that the global capital markets will say, these Americans don't have their act together, and therefore interest rates will rise even faster because of an unwillingness to buy treasuries at historic kinds of interest rates.
So that's why there are people who are worried about global recession, a deflation, because if all these excesses that you think have been built up are going to be unwound, it isn't going to be great for financial markets, and that would be bad for the economy.
But you don't want to keep making it worse by continuing to feed that with continued super low interest rates. And I think now the Fed has been very clear about where it's heading. As I said, I don't think they're moving fast enough to get there, but I think investors have certainly been warned that interest rates are moving, short rates are moving from 0 to 2%, and the curve being what it is, longer rates will move more. So they ought to wake up and start adjusting their portfolios.
You know, if equity markets are a leading indicator of economic activity, which most people say they are, then this year we've seen equity markets across the globe, barring just a few countries, actually down. And 2015 has been a negative return year for most asset classes. And other than a few sectors in the US economy, which includes technology, consumer, a bit of healthcare, most every other sector, the stocks are down. So, you know, that is, some of this unwinding is already begun.
Yes, good. The more gradually it happens, the better. But as I said, even after this less than ideal performance of the US equity market, we're still looking at very much, I think, by historic standards, overvalued equity prices. Justifiable only by saying, but look at what the alternative is. You get nothing at the short end, you get a little more than nothing at the medium end, so why not hold equities where the dividend yield beats what you can get on a 10-year government bond? But I think that's very short-sighted.
Shifting back to the US dollar, if interest rates, you believe, are going to continue to rise in the way you're describing, what does that mean for the US dollar? It's already strengthened so much.
Well, it has strengthened, and certainly that is what some other countries were hoping would happen. So it's not polite for a central banker to say, I'd like my currency to fall relative to something else, and I'm adjusting my monetary policy to make that happen. But it is clear that that was the goal of the Japanese with their quantitative easing. It's clear that the British wanted to do that. It's clear that's what the ECB has been trying to achieve. Now, they've achieved it to a certain extent. If you look at the euro, it's down about 15% relative to the dollar. Not on a trade-weighted basis, because at the same time sterling was weakening, the yen was weakening. Now China has decided to join the weakening game. Fed really didn't do anything for the euro. In fact, the euro is slightly stronger relative to the dollar than it was a couple of weeks ago. Whether as the interest rate continues to rise in the US and the ECB holds to zero negative rates in Europe, whether that will achieve what Mario Draghi and his colleagues are seeking remains to be seen.
So what is your prognosis for the currencies? Do you believe that the US dollar should strengthen and the yuan should continue to weaken?
I think it will strengthen. I think that's just a byproduct of raising interest rates in a world economy where others are not raising interest rates. So it's not so much a should as it's just a natural market reaction. And I don't think there's anything we can really do to prevent it. And I don't think we should avoid normalizing interest rates in order to prevent the normalizing of the exchange rate.
Actually, you've seen China a few weeks ago, you've seen India, so we can actually get your thoughts on both of these economies. So let's start first with China.
Yeah.
Does the data that we see of GDP growth, Does that seem real to you, or do you think things are far slower than what the data is even suggesting?
You know, going to a few meetings and walking on the street doesn't really give you a sense of GDP. Talking to the people who are experts there, I get the sense that they think that the 7% number is probably overstated, that maybe the real number is 5.5%. But you know, as these economies get to be more service-oriented, it gets harder and harder to measure real output. So when you're just doing tons of steel and tons of cement and bushels of rice, it's pretty easy to get a sense of what's happening to GDP. But now, as China, like the US, becomes more service-oriented, it just gets very hard to know how to translate the numbers into real numbers. And so I don't think we can get hung up on whether it's 5% growth or 7% growth. But I would say, for whatever it's worth, the experts that I've talked with in China say, well, 7 probably is stretching the truth, and the reality is somewhere in the 5 to 6% range.
And do you believe that the yuan should continue to weaken further?
Well, of course, there was a lot of fuss made when the Chinese abruptly moved the yuan by 2.5%. They should have said, you know, on a real trade-weighted basis, the yuan has been strengthening substantially relative to the yen, relative to the euro, and so on. So we need to make an adjustment. But they didn't do that. They moved against the dollar and got booed by the global financial community. Now they have correctly said we've got to think about the yuan relative not to the dollar, but to all of the major currencies that we compete with in global markets. So that's a code for saying we're going to lower the value of the yuan relative to the dollar. It'll still not offset, I suspect, the full change in the ratio of the yuan to a trade-weighted basket. But I think we've seen another 5 or 6% move in the yuan, and there probably will be some more going forward.
But do you think the transition to the services sector and more consumer orientation is being successful, and the Chinese economy is going to, not going to have a hard landing, but will actually come out of it?
I think it will not have a hard landing. I think that they are making some progress towards increasing the share of GDP going in consumption, the share of services going in consumption, as I said a minute ago. The trade balance has shrunk substantially, so they're moving in that direction. They've set a goal which is going to be hard to achieve. They've set a goal of 6.5% real GDP growth for the next 5 years. And if I had to bet money today, I'll bet that if we talked 5 years from now, they will say they achieved it. Does that mean they will have achieved it? Not necessarily, but they will say that they have achieved it. Now, why is it so hard, given that they've basically had more than that for the last 5 years, at least as they do the accounting? And the reason is that the population in China is plateauing out, and the working age population. So they cannot get the growth based on increasing numbers of workers. But the key is to move workers from the rural area into the cities, because there's still a very large, very low productivity rural workforce. So if they can move those people into the cities, that plus normal productivity gains for what is a relatively low productivity, low income economy, will give them their 6.5%. So they are already beginning to implement policies to encourage and to make it easier for people to move from the rural area into the cities, and therefore to pick up the urban labor force.
So now we'll shift to India. So it's great to have this interview with you in India. You've just attended the Neemrana conference, where a number of leading economists have discussed what's happening in India and the global economy. So tell me, you were here last year, you said you've been coming for 20 years. How do you see things different this time?
There are some things that look better, but in a sense, I don't see as much progress as I had hoped. Last year when I was here, we had a chance, the group that I was with, had a chance to meet with Mr. Modi. He's a very persuasive, very attractive proponent. And so that reinforced my sense that he was a man who was on the right track and that we were going to see good things happening. And it's clear that in some areas good things are happening. The financial inclusion policies, I think, represent significant progress, and the creation of these personal accounts, the use of bioidentifiers, that has real prospect for doing important things. The GST hasn't happened, but everybody I talk to says within 12 months that's going to pass. So that's good news. The failure to deal with labor market rules and pushing it out to the individual states, to me that's a failure. And the notion that the states will compete for industry, will compete for foreign businesses by making their labor market rules more flexible. I understand the theory, but it doesn't sound in practice. So, as I understand, Rajasthan has changed the rules for firms up to 300 employees. Well, I can't imagine a major international firm caring. 300 is just too small. I'm going to set up a plant and want it to grow. 300 is not enough. And it's true in Rajasthan now, and it's been approved by the president, but who knows what will happen going forward. So I think so far we're not seeing progress there in the land use rules. Again, the hope that I felt at least was part of the Modi strategy a year ago has now been pushed off to the states. So for those reasons, I'm,
But structurally, India obviously has those challenges. It's a democracy.
Yes, right.
There's a state and center,
Right.
governed by different parties often, and getting things through parliament isn't always
Right,
the
so
easiest thing.
this is, right, I understand all that. You asked me how I perceive the economy doing, and I tell you that for all those reasons. There also doesn't seem to be, on the part of the national government, a kind of pro-market stance. There isn't a sense in which state-owned enterprises should be reduced. I mean, even China has succeeded in doing that to a large extent. 20% of employment in China is in state-owned enterprises. Now, there isn't the same mix of informal sector and formal, so I don't know how to compare China.
So you're saying there should be more privatization?
More privatization.
Mm-hmm. And how do you feel about the monetary policy in India right now, given where inflation is, the rate cycle? What's your view on the rate cycle in India versus, obviously you're of the view that in US rates have to go up. In India, do you think rates need to come down?
I am pleased to see that inflation has come down here substantially. I gather that the goal is to have it come down another notch going forward. I think that means that there has to be some tightness in monetary policy, a sense that the RBI is committed to bringing inflation down. So that's a...
So, just finally, pockets of carefully chosen opportunities in the US, cash, some emerging market assets are where you think one should really be focusing on, not so much Europe or Japan.
I think that's a fair description. Mm-hmm. Yeah.
And you'll be long the dollar, or you think that the currencies are pretty much?
No, I think the dollar will probably rise relative to some of these other currencies. Whether it's enough to offset other things, that's a separate issue.
But thank you, Dr. Feldstein, for joining us. It was wonderful to have you here in person and to discuss the global economy. It's been a pleasure, and thank you so much for giving us the time.
You're very welcome.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.